I get the questions all the time. Are dividend stocks really worth it? Can I really make money in dividend stocks? And the answer is emphatically yes. But the problem most investors have is they lack patience. The moment one of their stocks drop maybe 10%, they sell. Emotional trading is a losing strategy. And when you take the power of compounding dividends and you add in patience, allowing that process to play out over time, you could build yourself a treasure trove of passive income. Yep, I said it, a treasure trove. And in today's video, we are going to take a look at 5 forever dividend stocks. These are 5 of my favorites. But before we do me a huge favor and smash that like button down below, as that really helps the growth of this channel and it helps spread the word to other investors as well. And with that being said, let's jump into the video. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me take a quick moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great products and resources available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks right now, completely free. Now let's get back to the video discussing 5 forever dividend stocks. Now these are 5 favorites of mine, but it's not an all-encompassing list. And let's begin with dividend stock number 1, which is Apple, stock ticker AAPL. As many of you are probably aware, Apple is the largest company on the US markets. They currently have a market cap of $3.05 trillion with a T. Over the past 12 months, the stock is up 29%, and over the past 5 years, the stock is up 306%. After all, Apple probably doesn't need much of an introduction at all. You likely already own multiple Apple products, and you may even be watching this video on an Apple product. But just to quickly refresh, they have products like the iPhone, the iPad, the MacBook. They also have wearables and then their fast-growing services segment as well. The company is an iconic American brand and was really revolutionized and reborn under the leadership of Steve Jobs when the company introduced their iPhone, their first iPhone, back in 2007 at a time when the US economy was about to drift into the Great Recession. And since that time, Apple has not really looked back at all. They were the first company to reach a $1 trillion market cap. They were the first company to reach a $2 trillion market cap. And you guessed it, they are now the first company to reach a $3 trillion market cap. Apple is well known for many things. Not only do they have great products, but they've also made a lot of people a lot of money. But one thing they're less known for these days is their dividend. The stock currently yields a dividend of only 0.5%. But it is not due to them not increasing the dividend because they have done that for 11 consecutive years now, although the dividend growth has slowed the past 2 years. However, if you recall, the dividend yield has an inverse relationship with the stock price. So even though they increase the dividend every year for the past 11 years, the stock has climbed 300% as we just saw the past 5 years alone. Thus, the yield has continued to fall because of this. But that's all right because we invest here for total return. Now let's look at valuation, and again, this video is focused on forever dividend stocks, which may not be a buy list for today. Apple is one of those stocks I wouldn't really buy at current prices. Number 1, I already own some, and number 2, the valuation is a little rich here. Over the past 3 years, Apple has traded at a price-to-earnings multiple of 27.7 times. Most of the time, I prefer to look at the 5 and 10-year averages, but Apple is a much different company today than they were 10 years ago. Much more service and subscription-based, which alludes to a higher multiple. So, a 3-year average of 27.7 times, analysts are calling for next 12 months EPS of $6.60, which implies 10% EPS growth, which currently equates to a PE multiple of 29.5 times. Now again, I already own shares of Apple. They have had an incredible run. So at this valuation, I'm just going to sit tight and hold my shares. Again, these are forever dividend stocks and wait for another opportunity to add to my position in the future. Now let's move on to the second forever dividend stock, which is Microsoft Corporation, stock ticker MSFT. We are going from the largest U.S. company in terms of market cap to the second largest U.S. company in terms of market cap. And Microsoft is one I have a ton of love for because they have a very diverse portfolio. The company currently has a market cap of $2.64 trillion. Over the past 12 months, the stock is up nearly 40%, and over the past 5 years, they are up 240%. Microsoft is one of my favorite companies for a number of different reasons. As I mentioned, they have a strong, diverse portfolio. They have a very strong management team, great leadership at the top. They have a AAA rated credit rating, and they just have consistent results. When it comes to Microsoft, they have long been known for their operating system as well as their suite of Microsoft Office products, such as Microsoft Excel, Word, PowerPoint, and other things. But the new Microsoft is much more subscription-based focus. A lot of those tools and those products are now a monthly or yearly subscription. And they're also diversifying their portfolio into things like cybersecurity, gaming, which continues to grow, and they are a major player in the cloud segment. To put it frankly, they are a giant in the technology space, and the company and the stock price has really continued to grow and make folks a lot of money. But one thing that has hurt is the dividend yield. Microsoft is another company that has been performing quite well over the past decade, but that performance has taken a toll on the company's dividend yield today. Looking at this chart, you can see how 10 years ago, investors could have picked up Microsoft shares with a yield near 3%. Today, new investors would only earn a yield slightly below 1%. As you can see, again, it's not due to the company keeping the dividend flat as the stock price grew. No, in fact, they have increased the dividend at a faster rate than Apple, especially the past 5 years, with a 5-year dividend growth rate of 10%, and they have been increasing their dividend for 20 consecutive years and counting. Now let's look at valuation, where again, the stock, especially in 2023, has been booming, so it may look a little rich at current levels. Analysts are looking for next 12 months EPS of $11.05 per share, which would imply 15% growth from this year, which is much more reasonable for a higher multiple stock. This equates to a forward price to earnings multiple of 32.1 times. Over the past 5 years, though, for comparable purposes, shares have traded at an average of 31 times, and over the past decade, closer to 25 times. So with Microsoft, you get a very diversified technology company. They have their hands in a lot of different areas, but the multiple at over 32 times is still a little rich. I would like to see it closer to that 25 to 28 range until I pull the trigger to add more to my position, which is already a sizable position in my portfolio. Now moving on to Forever Dividend stock number 3, which is the Home Depot, stock ticker HD. The Home Depot has been a fan favorite among the dividend growth investing community, as they have offered not just strong dividend growth like we'll look at here in a second, but they've also performed quite well in terms of their share price, adding to that total return that we're looking for. Home Depot currently has a market cap of $318 billion. Over the past 12 months, the stock is up 7%, and over the past 5 years, they are up 60%. Home Depot is the largest home improvement retailer here in the U.S. They operate largely in a duopoly with the likes of Lowe's companies, stock ticker LOW, which is another great dividend stock in itself. However, Home Depot has really separated itself over the years based on their efficiency. Not only have they been able to generate strong revenues and strong same-store sales, but they have done it in an efficient manner. Looking at this chart, you can see just how consistent the company was at growing their free cash flow from 2013 up until the global pandemic struck, and that pushed a ton of demand forward. Consumers were stuck in their homes, some forced to remodel areas to create more working space, and some who had held off on projects for years now found the time and money to do it. As free cash flow spiked, they expectedly fell the following year as demand fell off, but are now back to climbing higher again. As a dividend investor, free cash flow is such an important component to look at. Not only does it tell you about the safety of the current dividend, but it also tells you about the company's ability to continue to grow the dividend. Because after all, free cash flow is where dividends are paid from, but also where debt is paid from as well. As I mentioned a few minutes ago, Home Depot has been a strong dividend growth stock. And as you can see on this chart, the quarterly dividend has climbed from just 40 cents in 2013 per share to $2.09 per share on a quarterly basis, which equates on an annual basis to $8.36 per share. This puts the current dividend yield at 2.7%. As you can see here, Home Depot has a 5-year dividend growth rate of 15%, and they have been increasing their dividend for 14 consecutive years. So as you saw there, Home Depot has the fastest growing 5-year dividend growth rate of the 3 stocks that we've looked at so far. And as we continue on the list moving forward now, we're not only going to look at some great dividend stocks, but we're going to look at some great dividend stocks trading at great valuations. Over the past 5 years, Home Depot shares have traded at an average earnings multiple of 22 times. Analysts are looking for January 2024 EPS of roughly $15 per share, which equates to an earnings multiple of 21.3 times, slightly below their 5-year average. Home Depot is a great company that has shown their ability to generate strong amounts of free cash flow, and that strong free cash flow has led to a rising dividend. Now, before we move on to the last 2 stocks, let me tell you about a special promotion over at Webull. This special will give you some free stocks. If you sign up using my link down in the description below, deposit just $100, they will give you up to 12 free stocks, and those 12 stocks could be valued up to $3,000 each. That means we're talking about upwards of over $30,000 just by signing up and depositing $100. Check out the link down in the description below. Now moving on to dividend stock number 4, which is SBUX Corporation. Stock ticker SBUX. SBUX is a global company, and their 2 largest markets are both here in the US as well as in China. The company currently has a market cap of $116 billion. Over the past 12 months, the stock is up 23%, and over the past 5 years, they are up 100%. SBUX is one of those iconic brands with locations all over the world, and they have a very loyal customer base. As of their latest quarterly filing, the company reported having 30 million subscribers just in the US alone to their rewards program, and that number grew over 15% year over year. Rewards members account for roughly 60% of the company's transactions here in the US as well. Under the leadership of CEO Howard Schultz, who just recently handed over the CEO reins to a new CEO yet again, but he has transformed this small coffee company into a global coffee powerhouse. There are now SBUX locations all over the globe, some on every corner it seems like. They have SBUX Reserve locations for some of those complex coffee drinkers. They've added breakfast and lunch options, new innovative drinks that appeal to various customers, and so on. This has helped the company to not only continue to generate higher revenues, but generate large amounts of free cash flow. As you can see here, the pandemic crippled the business as many cafe locations were closed down for an extended period of time, but SBUX quickly moved to more drive-through options and outdoor pickup options during that period. And now things are starting to normalize yet again a little more, even though the growth in China has been slower than expected. Looking at this chart here, you can see how the quarterly dividend has grown from 12 cents per share in 2013 to now paying 53 cents per share on a quarterly basis, which equates to an annual dividend of $2.12, giving it a dividend yield of 2.1%. SBUX has been growing their dividend at an average of 12% per year over the past 5 years, and they have raised the dividend for 12 consecutive years. Now for valuation. Analysts currently are looking for next 12 months EPS of $4.08 per share, which equates to an earnings multiple of 24.9 times. Over the past 5 years, for comparable purposes, SBUX shares have traded closer to 30 times. So there's some value to be had in SBUX, especially once the China economy returns to growth. Now moving on to Forever Dividend Stock number 5, which is Johnson & Johnson, stock ticker J&J. Johnson & Johnson is a healthcare conglomerate with operations all over the globe who has gone through some major changes here in 2023. The company currently has a market cap of $413 billion. Over the past 12 months, though, the stock is down 7%, and over the past 5 years, they are up nearly 30%. Johnson & Johnson is a well-known company with a 100-plus year history, and many of the products that they're most well-known for come from that consumer health segment that they've had for a long time. They include the likes of Band-Aid, Tylenol, Motrin, Zyrtec, Listerine, Neutrogena, Aveeno, and the list goes on. For years, the company has operated under 3 operating segments, which included consumer health, which had a lot of those products that we just went over. They also had the pharmaceutical, which is the largest segment of the business, and they also have the medtech, or medical device segment. However, in 2023, these big changes that I'm talking about, the company actually spun off its consumer health segment into a separate public company called Kenvue, trading under the stock ticker KVUE. Kenvue went IPO in May of 2023 at $22, and they're now up 10% since that time. However, Johnson & Johnson still owns roughly 90% of the new business, but the company recently made some comments about looking to launch an exchange offer to divest its ownership within the new company, so there will be some news coming on that very soon. That leaves the new Johnson & Johnson company with the segments of pharmaceutical, which has long been its fastest growing as well as its largest segment, and then also the medical devices segment, which has really been turning around of late as well. Johnson & Johnson's also in the news for reasons they prefer not to be of late, as there was a number of cases around their talc-related baby powder in which lawsuits allege may have caused ovarian cancer to a number of these patients. Another case in California recently wrapped up in which a plaintiff was awarded $18.8 million related to a suit regarding the same product. But Johnson & Johnson said they will appeal as important facts were not shared, which would clear the company from this wrongdoing. So there's really a lot going on right now when it comes to Johnson & Johnson. They've split off part of their business. They're going through some major lawsuits right now that they're hoping to clear up. So I really understand it, as investors have really been taking a wait and see approach. However, with the new business, the new Johnson & Johnson, the pharmaceutical segment is still well intact. They have a loaded pipeline of both current drugs and a loaded pipeline of upcoming drugs as well. Like the other companies we have discussed today, all of them have something in common. They have the great ability to generate large amounts of free cash flow, and Johnson & Johnson is no different. After all, free cash flow is the name of the game, whether you are a dividend stock or not. Where Johnson & Johnson differentiates itself from the others on this list is the fact that they are not only a dividend aristocrat, meaning they have increased their dividend for 25 or more consecutive years, but they are a dividend king, meaning they have increased their dividend for 50 or more consecutive years. In fact, Johnson & Johnson has increased their dividend for more than 60 consecutive years. Johnson & Johnson currently yields a dividend of 2.9%, and they have a 5-year dividend growth rate of about 6%, so higher yield but lower growth. Now for valuation, which looks quite intriguing given the unknown about the ongoing litigation. Analysts are looking for 2023 EPS of $10.65 per share, which equates to a forward price-to-earnings multiple of just 14.9 times. Over the past 5 years, for comparable purposes, Johnson & Johnson has traded at an average multiple of 17.2 times, which is actually also in line with their 10-year average as well. So at these levels, Johnson & Johnson does look to be trading at a great level. So there we have it, 5 Forever Dividend stocks. All 5 of these companies generate huge amounts of free cash flow, and they have been able to weather the storm regardless of the economic backdrop. Down in the comments section below, let me know which of these 5 dividend stocks would you consider a forever dividend stock. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next video. Take care.